Your financial success at the end of the day comes down to a simple financial formula. It is your income minus your expenses equal your investments plus savings. This is where real wealth, financial freedom, financial success lies. Because what happens to so many people is you have an income, whatever it might be, a big income, a small income, but then your expenses equal or are greater to your income. Because now if your expenses are equal to your income, you have no investments, you have no savings. If your expenses are greater to your income because you have debt, credit card debt, you have a whole bunch of consumer liabilities, well now you're negative here because you don't have the ability to invest and save right now, and you're not going to have the ability to invest and save tomorrow because your future income, tomorrow's income, is going to be going to pay off yesterday's car. So if you have income now which is greater to your expenses, now you have money that you can put aside for investments and you have money that you can put aside for your savings. The next mistake that so many people make is that all their extra cash goes here towards their savings, and they put little to nothing towards their investments because investing your money is risky and we're never taught about investing. How do I start investing my money? So what do? You do the safe thing. You save your money in the bank. Now, while most of us are taught that saving your money in the bank is a safe way to invest our money, the reality is, in today's economy, saving your money in the bank is a guaranteed loss. You are guaranteed to become poorer each and every day by saving your money in the bank. It's kind of funny. My first video to go viral was a video that I released in early March of 2016. And when I released the video, the whole premise of it was, when you're saving your money in the bank, you're becoming poorer each and every day because back then in 2016, inflation was between 2 and 3% a year. So what I said was, when you put your cash in the bank, you're losing 2 to 3% of your value every single day. So if you had $1 million and you put this $1 million in the bank, after 1 year, you would lose $20,000 to $30,000 worth of buying power just by keeping this cash in the bank. And that video was my first one to go viral. And now here we are today in this economy where inflation is significantly higher than 2 or 3%, which means that it's an even more painful investment to keep all of your cash in the bank. Now, you can and should save some money smartly. Like, you should save some money for an emergency. You should save some money for big purchases. You should save some money for investments. But you should not just save your money to save it. So this is where you have to know, why are you saving your money and what is the strategy to save your money? Because those are the 3 reasons why you should be saving your money. Save your money for an emergency, have 3 to 12 months worth of expenses depending on your risk tolerance, save money for big purchases, save money for an investment. If you're not saving your money for one of these 3 reasons, then this money should be invested. Now this is where everybody says, how do I invest my money? I've never learned about investing. I was never taught about investing. Investing is risky. And you're right, investing is risky. There's a chance that you will lose money when you invest. However, when you save all of your money, you are guaranteed to lose value. It's a guarantee. I mean, you're not going to get an interest rate in the bank that is going to exceed inflation, especially in this economy. Maybe 30 or 40 years ago it was possible, but nowadays, not so much. If you start this early, let's say you start when you're 18 years old and you can find a way to put aside $500 a month, which is just over $16 a day, and you invest the $16 a day, $500 a month, and you do this until you retire at 65, and you never increase how much money you invest. So you just stick with the $500 a month, and you start this when you were 18, $500 a month, put that right there, and you can get a 10% annual return on your money, which is the average stock market real estate return historically. That doesn't mean that it goes up by 10% every year, but over the long term, we've seen the stock market and real estate market grow by between 7 to 10% a year. If you do that, you will retire with almost $6 million in your bank account with your $500 monthly investment, and I'm still assuming that you're not increasing the amount of money that you're investing. Now at this point you might be thinking, but Jaspreet, the 10% annual return is high. I don't know if I can do that. Well, let's assume now that you start at 18, you put aside the same $500 a month, but now instead of a 10% return, you can only get a 7% return on your money. If you do that, guess what? Now you're retiring with over $2 million. And this is assuming now you get the lower end of the annual returns. And if you still can't even meet the 7% return, let's go a little bit deeper. You start at 18, you put aside the $500 a month, but now you can only get a 5% return on your money, which is a below average return on your money. Well, now you still have over $1 million, so around $1.1 million put aside for investments from just your little $500 monthly investment. But now what happens if you're like the majority of people and you don't have this sort of financial education when you're 18 years old and you start learning about money a little bit later? So now you start investing your money when you're 45 years old and you start with the same numbers here. Let's assume that you start with the same $500 monthly investment and you can get a 10% return on your money. In this case, if you started at 18, you're going to have $6 million. In this case, if you start at 45, well, you're not going to have $6 million or $2 million or even $1 million or even $500,000. You will have less than $400,000 when it comes time for you to retire, because now your money has less time to grow. So what do you do in this situation? Well, you might say, well, I'm 45, I'm going to have more income so I can invest more aggressively. All right, so let's do that. So now you're 45 years old and now you're not investing $500 a month. We're going to double it to $1,000 a month. And you can get the same 10% return because now you're smarter, you're more educated, you can get a better return on your money, and now you're still not going to have $6 million or $2 million or even $1 million. You're going to have now $750,000. Not bad, but nowhere near what it could be if you just started a little bit earlier, even though you're investing more money right now. But now, what if now you have even more income and you can invest even more aggressively? You start at 45 now, and now you're investing $2,000 a month, getting the same 10% return because you're smarter, you're older, and now you're not getting the $750,000, you're going to have $1.5 million. So now you're going to have to really make up for that lost time, because now you need to invest more aggressively here and you need to invest more aggressively here. So if we come back to this formula where your income minus your expenses equal your investments plus your savings, a lot of people assume that, okay, I'm young and I don't got to worry about this side of the equation because, well, I just spent so much time in school, I finally got a good job, now it's time for me to enjoy these expenses. It's time for me to buy a nice home, have a nice apartment, have a nice car, have some nice stuff so I can finally start enjoying my income. But what happens, and what we don't realize on this side of the equation, is that your investments here are actually compounded by time and, I'm going to put this over here, by time and the return, the interest rate that you can get. Because now the more time that your money has to grow, the more your money can grow and the much bigger it can be, and the better return you can get, well, the bigger your money is going to grow because you're getting a better interest rate on your money. Now, the way that you can get a better return is by either being more active in your investments. You know, you can invest your money in yourself, you can invest your money in your own business, you can invest your money into your own idea, or you can be more educated in your investments. Like if you be more educated in how you invest your money in stocks or real estate or maybe even cryptocurrency, now you can look for ways to get better returns because you are a more educated investor and you can take more calculated risks. More potential risk, more potential return. However, it comes with that sort of education. On the time side, the only way that you can get this time back is now if you get educated and start taking action sooner. Now, if you're watching this right now and you're saying, well, I'm not 18 anymore, so I can't go back in time, and you're right. But the best time to start now is today, instead of just constantly keep waiting for a time where I want more income. Because once I have more income, then I'll be able to do more of this. However, we can always work to reduce this while also working to increase this. So you want to do a little bit of this, that way you can have more money going here. If you enjoyed this shorter clip from my longer videos, here's another clip that I think you'll love. And while you're at it, if you're interested in learning more about how to invest your money in real estate, our team put together an amazing guide on real estate investing. This guide goes over what real estate investing is, how to start using real estate to generate cash flow, and how to build wealth with real estate. This guide is completely free when you sign up for our daily newsletter. So if you want to read our guide on how to start investing your money in real estate, you can download that guide just by clicking that button right over there. Thank you for watching, and as always, keep hustling.